All right, so for anybody in the recording, welcome to our channel. And I would like for you guys to, well, for the recording, firstly, this is going to be a class on the seek and destroy profile, the classic ICT seek and destroy profile. Now, this is my interpretation of it. This is how I use it. This is my logic, but the model was based off my mentor, ICT. And I will show you guys how I kind of use it in my logic and basically, how I interpret it. So yeah, that's kind of the disclaimer at the beginning. Now, for everybody in class, thank you for coming. Make sure that during the class, you guys only unmute if absolutely necessary. If there's a question, you guys can ask to unmute in the chat. And all right, so this is also going to be a very basic explanation of the seek and destroy profile, because seek and destroy is actually quite complex when it comes to actually seeing it in the market. It can be found in many ways. It can be seen in many forms, and I'm going to explain what forms I kind of see it in during my trading. Okay, so this is a profile. Now, the interesting thing about this profile in and of itself is that it isn't necessarily a day trading profile, right? It can be in any time frame type of profile. So this one, you can find it on the daily chart. You can find it on the 4-hour chart, but you will predominantly find it on about the 1 hour, 15-minute charts, right? And this one is what's hidden inside consolidation. And it's also what people are afraid of. They're afraid to trade into consolidation because they believe that consolidation is innately scary, which it can be, right? Consolidation innately can be scary because of the fact that what ends up happening is, what is consolidation? Firstly, can anybody tell me what consolidation is? Also, I just got a piece of news. Let me check something real quick. But first of all, answer the question, guys. So what do you guys think? What is consolidation?
So price when being is within a range, that is called as a consolidation. When the price is being in a range.
Yeah, right.
Whether
Well, what I'm asking is, in terms of like bank orders, in terms of like smart money, talking from the topic is smart money. What
Liquidity, build
actually
up
is
liquidity.
exactly right? So it's a buildup of orders, buildup of liquidity. So that's technically what it is. I'm sorry, I just got some news that I think would be interesting. So Japan just released around 60 million barrels of oil from their reserves into the world markets, which will probably stabilize the prices of oil at least a little bit. And they do fall quite a bit, yeah. But apparently they're saying that price should fall for gas, or for oil, not gas, sorry, for oil, for crude oil at least. But anyway, I'm getting off topic, sorry. So if we think about it, right, consolidation, it ends up being, so firstly, we're gonna have to actually type this out, right? So consolidation. In terms of smart money, consolidation is simply the accumulation of orders, right? So if we know this, we know that simply the accumulation of orders, and in larger time frames, the taking of liquidity within a range. And we're actually going to focus on the second part of this definition for this class, okay? So for consolidation, right, it's simply the accumulation of orders, and in larger time frames, the taking of liquidity within a range. So if we're taking liquidity within a range, right, and we're actually looking, and we're seeing that price is trading within a range, meaning it's consolidating, we have to realize that there is probably a lot of liquidity within it. And if there's a lot of liquidity within it, we can actually our job of target definition becomes a lot easier. So I'm actually gonna draw an example for you guys. So let's say, and I'm going to go a little. Actually, you know what? I'm gonna keep the definitions on one page, and I'm actually gonna draw it somewhere else. Okay. Whoops. All right. So now let's draw, right? And let's say, for example, that price is going to make, it's going to start off here, right? And it's actually going to go lower, right? Let's say that price makes a low, right? And then from there, price goes a little bit higher, right? It retraces into the opening price, and now it creates a high. Now, after this, right, it goes within its range, right? Because we're studying that price generally stays within its range. So now what are we going to do? Well, price starts ranging. Okay. And we're going to leave it right there. So remember that this is just a drawing and it isn't supposed to accurately represent everything that the market does. But we're going to leave it right there. All right. And what we're going to do is we're actually going to talk about these 2 points. So obviously we see that price is consolidating at the moment, right? That's what we see. And how do we know? Very simply, price is within this range. And let me change the color of these lines so people don't get confused. Let's change it to red. Okay. Obviously, we know price is within this range. Now, if price is within a range here, what can you guys tell me about these 2 spots right here? What are they? What are they, guys? Can anybody tell me what they are?
They're stop runs.
Spring high.
Okay, so somebody said stop runs. Not quite stop runs, but it's a type of it's something related to that.
That is a spring low.
Not springs, no.
Liquidity grab.
All right, one at a time. Can you guys repeat that? Because I didn't quite get what they said.
Liquidity grab. Sorry.
Okay, so I kind of understand what you guys are saying. Sorry. So the first thing that I would like to say is that, so this is similar to, like, so some people are saying liquidity grab, some people are saying like stop run. Those are the same thing. But the thing that the reason why I said that it's related to it, but it's not the same thing, is because of this. This actually isn't a stop run. Not unless we know like that what's going on behind it, right? And we're assuming that this is not a stop run. So what this actually is that it creates sell stops, right? So it creates liquidity. So this is actually a liquidity pool. Or knowing, for example, would usually what it's called in smart money is a sell stop, like a group of sell stop orders. Why? It's because a lot of people in retail, what are they going to put at this point? So we're going to put sell stop or sell side. I usually call it sell side liquidity. Now, I use the term sell side liquidity as a very simple term, right? There's a lot more going on here, obviously, but it's very simple to understand. So the reason why I say sell side liquidity is because a lot of people in the retail world, what they're going to do is they're actually going to put sell stop orders at this point, and they're going to want price to actually hit this point, right? Later on in time. So let's say all the way over here, price falls beneath this level. It triggers them into a sell, and then it continues. So they're hoping to catch breakouts, and that's a lot of people in the market. That's what they want to do. So because of that, when that happens, what does that become? This becomes a target for liquidity, right? This becomes a target for banks to later target. So if this is sell side liquidity, right, meaning that it creates a low, what is this?
There's a buy side liquidity.
Buy side liquidity, right? So this is buy side. So you see that there's sell side and now there is buy side, right? So that's pretty simple to understand. Obviously, as I said, this is a very simple way to understand it. Obviously, if you want to go way deep into the theory, there's a lot more going on in terms of buy side and sell side liquidity. But for now, this is all you need to understand. All right. We're not going to have a deep dive into the theory, not until way later. Probably I'll do a way separate series on going way deep into the theory. But now, if these are buy side and sell side liquidity, then what is this? What are they? Can anybody tell me?
Sir, consolidation.
All right, so this whole area is consolidation. I'm talking about these lines up here. So if this is buy side,
Accumulation of
this
orders.
is sell side, right? Okay, so accumulation of orders. All right, so I'll show you how that answer is technically correct. Does anybody have any other answers?
Sir, resistance and support.
Okay, so some people are saying okay for support. Okay, all right. Not quite, but I'll show you why that could technically be correct.
An expansion, sir.
Expansion, okay. Not quite. No, not an expansion. I'm
It
talking
is-
about these lines, these red lines up here and up here. So the answer is actually very simple. They're the same thing. They are also buy side and sell side liquidity. When price creates a range, right? Obviously, if you were to put your premium and discount array, this would be your top, this would be your bottom, and you'd be inside. But when price creates a range, every single time price creates a range, there's going to be buy side and sell side liquidity on both sides. Now, on every retracement, there's not buy side and sell side liquidity, right? But what I'm saying is when price creates a major high or a major low or starts into consolidation, the top and the bottom, there's always going to be buy side and sell side liquidity. Now, whether buy side and sell side liquidity are both taken, that usually depends. But in this case, the seek and destroy profile actually relies on taking both of these sides of liquidity, which is the majority of the time what ends up happening. So let's extend these out to actually give us a little bit of kind of a little bit of leeway for us to see a little bit into the future. Now, I want you guys to think like institutions. If you guys had the power that institutions have, if you guys had the money that institutions have, and you made the most money when you stop people out and you take their money, what would you do? Right here, what would you do? Remember, there's buy side and there's sell side liquidity. And to explain that, you have to understand that at this point, there's going to be people selling, right? If it breaks through, people are going to start selling. Some people have bought, right, at these areas. Some people have bought at these areas if they think, retail support and resistance works. So let's actually draw that out so people aren't confused. So there are going to be some people that buy at this point because they think, okay, this is the third tap on resistance, support. So they're going to say, all right, so price is going to buy from here. So I'm going to buy, and they're buying off of resistance and support, right? Now, if we take the same theory and we apply it to shorts, we also realize, right, that some people, or a lot of people actually, are actually going to be selling. Now, why would they be selling? Well, they're probably going to be selling because they believe that price, once it breaks through this low, it's going to break out and just continue going lower. And they want to be a part of that. So what do? Well, they end up taking their orders and putting a sell stop right here. So if it breaks through, boom, you trigger their sell stop. Now, if you were banks knowing this, right? If you were banks knowing this, I want you guys to tell me, what would you do? What would you do to stop people out?
We will hit a stop loss, whatever side they had put in.
Okay, right. You're right. The point is to hit their stop loss, right? But how would you do that? How would you manipulate the market right now?
I will move the price lower first, at least 30 pips to take everybody out of 50. And then I'll go upwards and I'll take the buy side liquidity from the consolidation and from the higher.
Okay, all right. So the doctor has given her opinion. What about everybody else?
First of all, sir, spring is lower.
Okay, lower.
Then upside and break the picture.
Okay.
Then mitigation, and then buy side.
Okay, all right. So what you're saying is you would take price lower, take people out, then you would break structure higher, retrace, and go higher. So you're kind of you like the classic. So you're going for like kind of a consolidation into a classic buy day type thing, right? That's kind of what you're going for. All right. So I can respect that. I can respect that. All right. Does anybody have any other question? Sorry, not questions. Any other opinions that they would like to share about this specific, like what they would do to stop people, the majority of people out? Remember, you want to stop the majority of people out. So you have the power right now to do all those kinds of things. What would you do?
So is it necessary that price whenever takes the one side liquidity, it will go in that direction only? Suppose if price takes a downside liquidity first, it will go in downside only.
Price can't do that. Price can't do that, but generally it won't, because it's very inefficient, right? So if price just ends up like tanking from here without taking any sort of buy side liquidity, it does happen, and for the majority of times it actually can happen. But the problem is that later on, price isn't going to stay like this because there's a lot of buy side liquidity up here. So since there's a lot of buy side liquidity up here, it's not going to leave that money untapped. So what it's going to do is it probably would go lower, and then later it would retrace, take this higher position, and then continue dropping, right? That's what you would want to see. And that's actually what we want to see on NZD USD. But I was taking a calculated risk because probably price, retraces and then continues up higher. But that's exactly what we see. There was liquidity back here that we definitely can take in the future. And when we take it, right, we expect price to go lower. So similar to that, right? That's kind of what you're saying right now. If price were to just drop, this leaves an open liquidity pool, right, later on, and price will retrace back into that. Okay. I hope that answered your question. Yeah, I hope that answered your question. Yeah, no problem. Okay, so now I'm going to give you guys the answer. And the one who got it the most correct is actually the doctor, the good doctor, right? She actually got it very much correct. So so this profile actually relies on taking people out by going slightly lower, not taking every point of liquidity lower, but they go slightly lower, right? And just as a side note, remember that these are targets. Okay, remember that they're targets. Remember that they're targets, right? Now, price slightly stops people out, very slightly, right? It goes lower, it breaks the sell side liquidity. So sell side liquidity, at least locally, has been taken out. Now, once it's been taken out, what are we going to do? Well, if I was a bank, what I would do is buy side buyers, right, have already been taken out. So long, anybody who's long here, anybody who's buying is out, right? They just got stopped out. They're like, dang it, I lost my money. Oh, well. Some people may even panic and they're going to start selling here, right? And the people who are selling, they're going to start selling short right here, right? They're going to start selling. Why? Because price broke out. Price broke out. Oh, it's going to go all the way down. So now I got to sell more. So more people are going to start selling and selling and selling and selling and selling and selling. So not only are people selling now, all of these buyers may turn into panic sellers. And some of these buyers, right, may just take their loss and move. Great. Now, what do you do with the overwhelming majority of sellers that are coming in now? Because they're panic selling, they're fear of missing out selling. What do we do now?
We go up so we can take them out.
We go up. And we go up not just anywhere, but we go up to take the other side of liquidity. And we do this for a very specific reason. I'm going to pause it right here. So we just took sell side liquidity. And usually this closed eye is what I denote as closed liquidity, right? So now we've taken this point of liquidity. Everybody who started panic selling at this point, right? We can make this bigger to denote like more sellers. Some people may have stubbornly held on to buys, but those are going to be very low. So there should be a very low number of buyers in the market right now and a very big number of sellers or new sellers. And, you know, very unfortunately, some people will sell right here and they will get the whole brunt of the move upward. But that's what happens, right? People lose their money in this market, and you know, we use that liquidity to make money ourselves, unfortunately. But you know, they don't know any better. Honestly, they don't know any better. So what ends up happening is now price, right, goes higher, and now what ends up happening? Let's do the same thing that we did here with the arrows and right here, and let's actually do it up here. All right. So now I want you guys to tell me something. Let's make them even again. What's going to happen with buy side liquidity with buyers and sellers? What's going to happen?
First, we take the ones that sold initially because their stop loss is above. We're going to take it out.
Mm-hmm.
But we will have a break of structure, so we'll make people think that we are going for a buy.
Mm-hmm. Correct.
And they can change the price to go all the way down instead of a buy. So now there are more buyers coming into the market thinking that we're going up.
Right, exactly. So what ends up happening in a very simple explanation right here is that the stop losses of the people who were selling down here, right, the big sellers right here, they get stopped out. You know, they get stopped out here in the middle, maybe all the way to the other side. Boom, they get stopped out. The banks are very thorough, right? They want to make sure that there are no survivors. That's why, basically, that's literally why we came up with the theory of extremes. Do you guys remember that theory of extremes? That price prefers extreme retracements rather than shallow retracements. Why? Because banks are very thorough. They want to take people out as soon as physically possible. They want to take them out as often as possible, right? And they want to take them all out, right? Even us, they want to take us out too. So now let's kind of think. Let's think a little bit. Okay. So sellers just got stopped out. So they're going to be very little, right? Very little sellers. Now let's think about what happened here. What are people going to do when they see price going towards the upside?
You're going to place more buys.
Right. A lot of people are going to start placing more buys. So if they start placing more buys, they panic sold here. So what can we assume people are going to do right here?
You're going to panic buy.
Panic buy, right? They're probably going to panic buy. Now, with that being said, if they panic buy, they're going to end up losing their money, but they're going to do it anyway. So they panic buy. And what's going to end up happening from here? What do you guys think is going to happen?
I mean, it depends what they want to do. If they want to take the buy side liquidity up there, they could retrace enough to take a lot of buyers out first, and then keep going up. Or they can retrace all together. I mean, change trend and go down and take the buyers out, and just go down and take the other liquidity from lower.
That's very impressive. Wow, that's actually you impressed me very much today. That's actually correct. That's very impressive. Actually,
I'm a beginner, don't forget.
So remember the theory of extremes. Price wants to take out as many people as possible. So what do we expect banks to try to do at this point? Probably end up retracing, right? We could probably say they end up retracing, and they're probably going to retrace in an extreme fashion. That could be going all the way to the end of the other side of liquidity, right? Kind of like stomping on their head again one more time, right? And taking out the rest of the liquidity and taking out these buyers. So the majority of these buyers get taken out. We can see a pretty extreme retracement, right? To us, it's not extreme because we're used to these retracements, but to retail traders who think the market is, flat, they think the market moves in trends. Well, they're going to think those are very extreme retracements. So now from here, like you said, very, very good. They will actually, so this can happen one of two ways, right? Usually what ends up happening, as I've seen, is the side that gets taken out first is usually the last one to get taken out in terms of its target. And I'll explain what I mean by that in just a moment. So right here, price retraces back deep into discount pricing, right? So if this is a range, right, then this is discount pricing. Now, what do I mean by that? Okay, I'm gonna stop that right there. So if we were to pull out our fib, right, and we were to pull out a PD array or a premium and discount array, if we were to mark our discount arrays, if we were to mark our arrays right here, we know, right, that the middle is equilibrium, right? The middle is the zero. It's the equilibrium. That's homeostasis, right? Now, if right here, if below, right, if price is below, what is that known as? That's known as discount, right? For the people that don't know, that's discount, and the top is premium. So if you're in discount pricing, you have a little bit more likeliness to buy. If you have a retracement like this and you're in discount and then you start making bullish order flow towards the top side, you're very likely going to buy. So that's exactly what banks are going to do. That's just a quick explanation of premium and discount. So if they retrace deep into discount, right, and they start making buy side moves, or at least seeming like buy side liquidity, what can we expect? Where do you guys think we're going? We already took out this liquidity. So where are we going?
Possibly downside whenever the higher time frame
Target.
indicates order flow.
Okay, so downside, but it's making buy side movements.
Sir, mitigation and buy side. Price side.
Right,
Buy-side
right.
liquidity target.
Right, exactly, correct. So the buy side liquidity target is exactly where we're going, right? That's exactly where we're going. Good attempts from you guys. I'll explain why I think I know exactly why you're thinking that. Let me just explain it a little bit better. All right. So at this point, right, we're making buy side movements while we're deep inside discount price. If we're at discount price, that means that banks are trying to get a better entry, right, to take out buy side liquidity. And when I mean banks, I mean central banks, right? Orders, IPDA, right? The interprice delivery algorithm, right? Now, right here, right? We end up we could retrace, and then from there, just to like kind of make the drawing a little bit simpler, we're going to end up taking our buy side target, right? So we end up taking our buy side target, and now from here, what happens at this point? Let me oh, whoops, I did not mean to do that. What happens at this point? Can anybody tell me what's going on at this point? What just happened? So buy side liquidity was taken out. What just happened?
Price has taken the buy side liquidity and secured a premium position for the next target.
Right. So it secured a premium position. So I really like your wording, Piyush. So it has secured a premium target. Remember that our higher time frame PD array starts from the low to the high. So we just came up, right? And we're now in premium pricing. Now we just took this buy side liquidity. So now the new high is here. But let's ignore that for a moment. Now we've taken out a lot of buyers right before our movement upward. Some, like most of the sellers, are dead, right? They're dead in the water. They're not going to be operating right now. Some people probably just sold up here, right? Some people sold, maybe some people got lucky and sold, right? But that's why we go above the buy stops, right? That's why we blow out the buy side liquidity. We don't just tap it, right? We blow it out. We try to take out some stop losses while we're there. Now, here, this also means that all of these buyers, or at least the majority of these buyers, were also taken out. Right? That means that the majority of these buyers were taken out.
Sure.
All right. All right.
Yeah.
So now, where are we going from here?
If we are at the premium, we'll sell from there.
Right. Exactly. So if you were a bank, or at least a central bank, right? If you were controlling the algorithm, and you said, okay, price has reached this top point. We've got a lot of money in our bank right now. We've taken a lot of liquidity, right? what if we just end up destroying like one side of our one side of the market? How would you absolutely destroy both sides of the market here? So here we've had pretty clear price action, right? We've had pretty clear price action. It's happened, you know, over a certain amount of time. There hasn't, you know, it's been pretty calm. How would you rattle the market right now? How would you take people out as much as you possibly can?
Drop to the sell side liquidity target.
How? You're right, but how?
Sir, bank manipulation.
Right, bank manipulation. So how quickly would you do it?
So just now we taken the buy side liquidity and we are having buyers in the market only.
Right, we have buyers, right? The majority of them are buyers, right? We're breaking out right here, right? So people are saying, all right, we're breaking out, we can buy again. All right, cool. What I'm
And
saying is now,
the
sorry, go
seller-
ahead. Go ahead, sorry.
We can become the seller for those buyer and target the sell side liquidity.
Right, exactly. So that's what I was saying, right? Now, what we can end up doing is from here, right? We can actually drop quite quickly, right? We have a lot of liquidity saved up, right, from taking people out, and we haven't used it. Notice how the movements here have been very, 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 you know, shallow. They've been very good. So for us smart money traders, that's great. You know, that's awesome, cool. Now, here, banks are probably going to try to use a lot of that liquidity here. Can anybody tell me why? And meanwhile, I'll draw it out.
It has to be fast so people don't have time to think what's going on.
Right, exactly. It needs to be fast so people are scared, right? Why are people scared at this point? They've just gotten stopped out once, twice, maybe 3 or 4 times, right? They've gotten stopped out quite a bit. Now, if they've gotten stopped out this much, they're probably not going to want to participate in the market. Firstly. Secondly, the banks have already gotten what they came for, their liquidity. Now, what do they use liquidity for? Can anybody tell me what they use liquidity for? To sponsor what?
Order blocks
Okay, similar
to move the-
theory.
to move the trends, you know, in the direction they want by putting a lot of money at once.
Right, exactly. So they manipulate the market by moving the market in their direction to their targets in a very fast movement, right? By putting a lot of orders in at once. That's very good. So now what ends up happening at this point is price, or right, when I say price, I mean the algorithm, is going to calculate for very, very, very fast movement towards the downside. And if it, you know, moves extremely fast, what's going to end up happening? Not many people are going to know what's going on, firstly. And secondly, people are going to want to stay out because they're like, oh, there was no entry given, no trade taken, which is very safe for us. What they don't want is they don't want people piggybacking on them when they take this move towards the downside and they absolutely destroy the sell side liquidity and they put a ton of sell orders at the top here. That's what they don't want. They don't want people piggybacking off of them and making money too. So what are they going to do? They're going to put a ton of orders here. They're going to restack on orders here, right? And they're going to just let it drop. Now, when price drops, they make a ton of money. And when I mean a ton of money, I mean a ton of money, right? They make a lot of money. But how did they get these orders to put all the way up there? How did they put the, because remember, they don't like using their money. They don't like it. So they're going to use ours.
I guess it's the money that they took from the liquidity.
Exactly. All the money that they took from making all this liquidity, they're going to put it in right here. They're going to reinvest it. They're recycling. They don't waste any parts of the buffalo. So what are they going to do? They're going to put all of our liquidity in here and boom. Now we see sell side targets getting destroyed. Now, when sell side targets get destroyed, they make a ton of money. They have a payday. And what happens? The next cycle starts. Why? Because they just ended up taking sell side liquidity. And just as we saw here, the same theory applies here. people are going to panic sell. Buyers are going to get stopped out. And what can we expect afterward? Very simply, price retraces.
We are at discount price now. They're gonna
Right. So,
retrace, maybe stop hunt both ways and then go up. I
so
mean,
now, hold on, just 1 second. So now what ends up happening is the same theory applies here, right? These these people who are selling do need to be taken out. So a retracement might happen. It might not even be a very, tough one. It'll just take people out as much as it possibly can. And then price can go wherever the next target demands it to go, right? It can go higher, it can go lower, it can consolidate again, right? But now we have the next cycle. So in terms of the classic model, this is the classic model, okay? This is the classic seek and destroy model. Now, the reason why it's called seek and destroy is very simple, right? It's like, like anything. The kind of how I reason it, right, is banks are looking to destroy liquidity, right? They're actively hunting for it. So if banks are actively hunting for liquidity, they're going to find it, right? They're going to find it and they are going to take it out no matter what. So what they need to do is they need to make sure that the majority of people lose money while they're doing it. So that then at the end of the day, they can sponsor their move with our money and they can make it quick, they can make it efficient, and nobody piggybacks on them. So they make money, you don't, right? And from those, a lot of those times, they could be news releases, right? So right here, so let's say, for example, this here could be FOMC, or it could be NFP, right? Or it can be some red folder news, right? Let's put it right here, red folder news. A lot of the time it can be red folder, right? And red folder just ends up taking a lot of people out and they're like, oh, wow, the US industrial CPI dropped by 5%. And people are like, wow, I have no idea what that means, but I'm going to repost it because it sounds intelligent, right? And they have no idea what they're talking about, but they know that something happened in the numbers and the market dropped. So everybody does it. They don't know. They're just sitting there and they're like, oh, cool. Numbers moved. News, dang news. They stopped me out again. And they are never going to bat an eye to it because it's going to keep happening. Okay. So does anybody understand? There's a good time to stop for questions. I'm going to mute myself very quickly, but you guys type your questions in the chat or ask your questions. I am hearing you. Okay. Just 1 second. I'm going to mute myself very quickly.
so news are used for two reasons, right? One, to justify their moves, and the second one is to make us believe that the price goes in one direction or the other.
All right, I'm back. Okay, so can you repeat your question one more time? I apologize.
Okay, so I think that news are kind of their way of either justifying their moves, their rapid moves, or make us think that it's going to be a move in a direction or other. It's just like manipulation. I don't know how true it is, but it has to make us think something.
Mm-hmm. Yeah, and it does, right? It does make you think some things. So a lot of people who trade fundamentally, they'll probably know a lot more than this than I do. But right, people who trade fundamentally, they will stare at the numbers, they will crunch the numbers, they will study the economics, but at the end of the day, they don't know what that number is going to be, right? They don't know what the number that's going to come out of that news is going to be. But of course, those numbers are already predetermined, right? They're predetermined to justify the movement in the market. So you really think those numbers are released the day of? Let me ask you that question. So let's say, for example, industrial CPI, NFP, stuff like that. Do you really think those numbers are released and calculated the day of?
No, they're preset.
No, they're probably already going to be known maybe a month in advance, right? They're going to be known quite a bit in advance. And if they know that, if the people who do the calculations know that, who do you think also knows that?
Smart money.
Smart money, right? They know those numbers too. There's, you know, that's not a stretch of the imagination. They know these numbers too. So if they know these numbers, well, now we think about it and we start thinking, all right, well, if these people, right, know these numbers, then it could kind of be determined that fundamental trading kind of has a flaw. We're kind of relying on numbers that other institutions know, but we don't. And we're relying on that gamble. Now, sometimes people get it right. And some people who study fundamental trading and like, they probably cracked it already, right? But from our technical standpoint, the only reason we look at news, can anybody tell me what's the only reason we look at red folder news? What's the only reason?
To know when to expect a move, a strong
Yeah.
move, maybe?
Exactly, right. To know when to expect a move.
When the time, not the price.
Right, exactly. The time, not the price. So we call that a driver or a volatility driver. And the reason why we call that a volatility driver is because a lot of the times, you know, price does end up moving in a certain direction. So we see that price, you know, ends up dropping like a rock right here. And people like at this point, let's say NFP happens at this point, and then it just drops. People are like, oh, wow, this is why we don't trade NFT. No, you don't trade NFT, but somebody else does, right? So this is kind of the reason why liquidity is such a visible and palpable theory in the market that is very concrete. Like a lot of people are saying like, oh, well, I can't see liquidity in the market. There's no indicator for liquidity in the market. Like, isn't it just volume? No, it's not. It's kind of like a scientific theory, right? If you can see that something happens, for example, you don't see magnetism, but you know that if you put a magnet on top of a piece of metal, you know it's going to get stuck there. And you know that if you put two magnets of the same pole close to each other, what's going to happen? They're going to push apart, right? They don't want to be together. But if you put opposites, then you know they're going to stick together, right? Because opposites attract. It's the same thing here. If after we've taken all this liquidity that we've marked here, and we know that the majority of people are short, like for example, let's say that the majority of people are short in this market, let's say at this point, right? If 80% of people are short and price suddenly changes really quickly and goes the other way, isn't it kind of scientific to deduce that the majority of these people have been stopped out? If not break even and loss, or very, very small profit? Yeah, we can probably deduce that, right? That's probably, you know, pretty accurate to deduce. Now, let me ask you something else. If once you've taken all this liquidity, you go from one point of liquidity to the other, that's also very, very, very important, because now you end up thinking, okay, well, you have buy side liquidity and you have sell side liquidity. You have both of these liquidities, right? And you've just taken both of them out. And in both of these cases, people lose their money. So obviously, you know, this theory does exist. There's a lot of proof for this theory. So this is the classic seek and destroy model. I'm going to make some small annotations on this, okay? And then I'm going to let you guys take a screenshot, all right? So if you guys have any more questions, please ask them now while I am making all of these annotations, so that way I can answer you as quickly as possible, okay?
Sir, first, whenever the price takes first side liquidity, is it necessary that price will go on that side only?
Okay, so I think you're asking like, so if price takes sell side liquidity, that it'll go, like, does it always need to go the other way?
It will go on downside only.
Okay, so you're saying like if price takes sell side liquidity, like can it just keep going lower?
Yes, sir. That's only.
Okay, so remember that I answered this question earlier, that if price keeps going lower, that's fine, but that's inefficient. Remember that there's still buy side liquidity. So price later on will come back, take this buy side liquidity, and maybe at this point it'll actually not come all the way up and take out this buy side liquidity. I'll actually leave it, but it'll take out this buy side liquidity and then it'll continue going down. You remember that I answered that?
Yeah, they need money for their big orders later on, so they need to take both sides. I do have a quick question. Why is called buy up there, you know, the resistance, and sell down there is just the opposite? So I'm just trying to understand why the name, you know?
Sell side liquidity and buy side liquidity, you mean?
Yes, yeah. So the top is buy side liquidity. Why is called
Right.
buy side and not sell? Because people sold there.
Oh, it's buy side liquidity because it's when you're buying. So it's like kind of the direction. So it's like, so if you're higher, you buy, if you're lower, you sell. So it's just like,
Oh, because people think that because you broke structure, they will buy from there. I understand. Makes sense.
you can literally just call it liquidity or a liquidity pool.
Yes,
It
yeah.
doesn't like we call it buy side liquidity. So like, let's say, so it's shorthand in the smart money community. So that let's say I'm talking to you over the phone and I'm trying to get you to imagine a chart and I say like, look, there's a lot of buy side liquidity. You know that there's liquidity towards the top side. That's all. Yeah.
I will
that's
call it upside and downside. You know,
You
that's
can call
why.
it upside liquidity, downside. That's fine too. Yeah.
Okay.
Whatever you want to call it. Yeah.
James, can we see some a couple of example or just one example on a live chart about this seek and destroy profile and where we
Ooh,
could have taken an entry?
that is a difficult one. I'm gonna have to see. Yeah, I'll check right after I finish these annotations. I'll go through some charts and see if I can find one.
Yeah, thank you so much.
Yeah, because this is actually one of the models that doesn't show up all that much. It does show up, but it shows up in certain circumstances, and when you see it, it's very good. But it's not as common as like the day trading profile that I showed you earlier or last week, right? So buyers.
And James, can we expect this seek and destroy thing every time when we are expecting some big news to happen?
So the majority of the time, yeah. So the majority of the time when there's a big news about to happen, seek and destroy kind of enters and it usually tries to take out liquidity beforehand. And that's kind of why you see that during FOMC weeks. Do you guys notice usually that during the weeks that there are FOMC, generally there's not a lot of movement in the market before that day? Do you guys generally notice that?
Yeah.
How like price kind of consolidates before FOMC? Yeah. So the majority of the reason why is because price is trying to consolidate orders. It is trying to wait for that big movement because they know they have an excuse for a big movement then. So why would they, use their liquidity to do anything other than wait? And then, price will rocket from there or it'll drop from there, right? Because they can put a lot of their orders at once due to FOMC, right? Does that make sense?
Yeah, got that.
Yeah. So now, almost done, guys. Almost done. Let me change the color on these so people aren't confused.
So based on your experience, what have you seen? What parts of this you can see once, like maybe they take only half one side liquidity? I'm not sure if they do that. And in what time frame? I know it happens in all of them, but in what time frame can you see their plan the best?
Usually on the hour. So for me at least, you can see the best time frame to study and master is the hour. Because you can go higher, you can go lower, you can zoom in, you can zoom out. It's kind of like it's the Swiss Army knife of time frames, because it's very it's very like it's very adaptable. So the 1 hour, I would say the 1 hour is kind of the easiest one. All right, so let me put this up here. So now buyers are active. Sellers are stopped out. Buyers enter. Late buyers. We can put breakout buyers.
Okay, another question. So, based on what I'm seeing here, it would be the best, I guess, the wisest thing to do. First of all, to not be trading in the middle in a consolidation, and to wait for either the premium or for the discount price. If you look at the price and forget all of the trending, right? We shouldn't trade in the middle.
So sometimes I do. So sometimes I trade in the middle because if I see a setup, there's a setup, you know, like if it's up here and I see that this is an order block and this taps it right here and this is going to take sell side liquidity, I take it. You know, like if you see a setup, take it, you know, but generally for the most part, these are going to be kind of difficult to trade. Now, I wouldn't say don't trade. I wouldn't say don't trade. I'd say be careful. That's all.
Small TPs, like in and out.
Right.
Tips.
Do you guys see how Garrison trades? I'm not sure if you guys have been seeing how he trades recently.
What's the Telegram group? I don't know.
It's the same one. He just has the blue charts. They don't let us sign our messages, so we we all have different charts. So mine is the black background with red and blue candles. Yeah, with red and blue candles. Garrison's chart is what's his background? Is it
black
blue?
and white?
It's white.
I guess white and blue. Yeah, right.
Yeah, his is white and blue, right? So his is white background, blue candles, and Zay's is white background, black candles, and Garrison's is opposite. So we all kind of have different chart styles. So if you guys see a specific chart, you guys know it's me or it's Zay or it's Garrison. I'm the only one with the black background, so that's me. I might change it to white. Kind of like the white backgrounds. Okay, so anyway, this is all of the changes I think I need to make. Maybe just this one here.
Sir, I have one question, sir.
Yeah.
Sir, all this structure is happened by normal traders or big short bankers like this way?
I'm not sure I understand what you mean.
Means this all structure means higher side means they break off structure due to the hand touch higher high going higher and lower low. All this means all this liquidity created means when normal traders are thinking market is in uptrend direction, but all normal traders are entering in that situation, and anyhow that's reversal in means going at reverse direction. Means all these things happened by whom? Means bankers or normal traders? Yeah, how like this?
Okay, so this I'm not quite sure what the question was, but I'm going to try to answer it to the best of my ability. So all of this happens remember that all of this happens not because of any normal traders. We don't have enough money to move the market. All of this is done by institutions, right? Institutional banks, stuff like that. They cause all of these movements, especially the large ones. Remember that the smaller movements are not actually instigated by banks. That's just the algorithm moving in certain things. If you guys remember the hierarchy of price from your basic training, the hierarchy of price says that there's a lot of computerized trading now, right? And that computerized trading essentially just tries to seek, and that's what creates a lot of this. That's why it happens so robotically every single time. Every time that you see these profiles, they happen almost the same exact way. And they happen the same exact way because they're done the same exact way by the same exact machines. So that's essentially what happens. So there's no reason to change it because, I mean, you know, it works. So if it works, why would you break it, right? There's no reason to fix what isn't broken. So that's essentially why this ends up working. Now all of these liquidity, right? Liquidity is sponsored by basically us. We are the liquidity, right? We are the people who lose their money and give it to brokers. And when we do that, right, who ends up getting that liquidity at the end of the day? At the end of the day, it's these institutions that end up taking, you know, they don't care about your $50 account. What they care about is they care about the big fish, right? The slightly bigger fish, right? The smaller funds, right? The smaller companies who are managing a lot of money, right? That's what they care about. They make them lose money. So that way they can take a lot more, right? Obviously, there's about $6 trillion in the market passing through every single day. So if that, you know, happens, if that happens inside the market, well, I mean, imagine how much movement there is inside and out, right? There's a lot of liquidity going in and out every single day. So if they can scrape off a certain amount of that every day and then put it towards a move, obviously it's going to move the whole market. So banks, and when I mean banks, I mean central banks, right? The people who manipulate this market, they're obviously gonna take out this liquidity, and it's kind of more like getting the most amount of money possible from people by stopping them out, if that makes sense.
I have a question. It just came to my mind, so I'm not sure if it's true, but the new higher highs in a trending. So let's say if I'm going up, are those created by retailers or those are actually the push of the bank?
Nothing is created by retail.
They can be created by
Nothing.
retailers?
No, nothing.
Exactly.
Nothing.
That's what it's not. It's like aha moment. I feel like when we are left alone, we can just consolidate. Just I think to buy, you think to sell, and we just meet somewhere in the middle, and then they are the ones moving. The high highs and the low lows, or the high highs, yeah, and the low lows are created by them, not by us.
These
with intention.
Higher highs, there will never be a time where we're left to our own devices. Sometimes banks will not participate. And when they don't participate, what ends up happening? Nothing.
Constantly.
It's flat.
Yeah.
Right. If we try to move the market ourselves, we're not going to. They're an ocean and we are a drop of water inside of a pipette. We cannot move the market. The amount of money that these institutions have is mind-boggling. Okay? They have more than countries. They're not.
So that means
yeah.
When we see a higher high, let's say, like for instance, out of that consolidation, when we see the higher high, no, actually we saw the lower first. We know that that's created by the bank.
Yes.
Then we have to think, okay, in this context, are they really going down, or this is just a sub hunt, and we should expect the other side to be taken out? So every single time we see a break of structure, we know that it's done by the smart money. And
so
we have to
remember that this is mostly in higher time frames. Yes, right. They don't care about lower time frames. They don't rate those. There's not somebody sitting at their computer trying to outtrade you. No, obviously not, right? But what ends up happening is that, so this isn't done manually. Most of the smart money that actually has the money that's in here probably doesn't even know this is happening. This is all controlled by the algorithm, right? And a lot of people say like, oh, that's such a conspiracy. No, the stock market is moved by a derivative algorithm. So if you don't think the foreign exchange market is moved by an algorithm, I don't know what to tell you, bud, right? Now, if we know that the market is moved by an algorithm, well, we can kind of think of it this way. It's kind of already preset to do certain things. So if it's preset to say, all right, we need to take as much liquidity as it can, and it knows that people remember, these institutions know exactly where you're placing your orders. So if they know that there's a lot of sell stop orders right here, or a lot of people waiting to sell right here, what are they going to do? They're going to throw them a bone and then immediately snatch back 10. Does that make sense? Right? So they know where our positions are. And how do we know that? Well, let me show you.
So they can see the volume of our stop losses, you know, in the broker. So is the algorithm changing according to the volume or the line where the stop losses are in general? Or is already?
Sorry, I was thinking about something else. Can you repeat that? Sorry.
Okay. So is the algorithm preset to a certain price, and it doesn't matter really how I say it is connected or not with what they see from the broker volume and where the sellers are and buyers. You know, many times people say that they have access to know how many sellers or buyers are in the market, and they go after them. But
yes, that's correct. They do.
So do they change the algorithm daily based on where the sellers and the buyers are?
No, the algorithm already knows to do. They don't need to do it. It's on autopilot.
But it's moving. The algorithm will decide.
So what the algorithm does, the algorithm calculates and synthesizes every order in the market. So back in the day, when the market first started, people would have to manually do the calculations using an equation to calculate the value, stuff like that. As the centuries went on, as the decades went on, it became more computerized. So it became more automated. Prices became spit out by computing machines. And now what ends up happening now is now we can see that price is now computerized completely. How do we see that? Well, have you ever seen a picture of the New York Stock Exchange? You think there are people in the back running crunching numbers madly with their calculator? No, that's all done through a computer. So they have their computers, right? And what ends up happening? Well, easily, the market spits out a number, right? And that's where all of these prices, that's where all of the prices on TradingView, you see all of these prices on TradingView. Let me share my screen again, 1 second.
This is amazing.
You see all of these prices on TradingView? This is plotted out, okay? So this is kind of a little bit difficult to, explain if you have not gone, if you like haven't studied charts before. So like, for example, let me put it this way. So every single time that an order is synthesized, what price is going to do, and we're on the 1 minute chart, right? So every single time that price is synthesized, you guys see how price goes up, down, up, down, up, down. You guys see how price does that? Like it continues going higher, then it goes like down. You guys see this?
Yeah, the pressure between buyers and sellers, you know?
Right, that's not pressure. That's the algorithm recalculating its new price.
Wow.
Right? So every time that new orders are synthesized, well, and new orders are placed, new orders are synthesized, boom, the algorithm calculates, and every single order that is being placed, well, boom, the market is reacting to it. Now, does that mean that every single time that there's a new order, or like, let's say you place a sell order at a 0.01, the algorithm is going to like drop a little bit? No, that is not the case. This is simply it calculating and recalculating. And
it's a sum of them.
Hold on one second. And then what ends up happening is, since a lot of the algorithm is also computers trading against each other, what ends up happening is a lot of these computers will keep trading the majority of the day. And that's what creates this kind of dead liquidity zones, right? And what I mean by dead liquidity is simply that price kind of just is sitting there. It's just dead. It's just like, it's not moving very much, but it's still moving. And those are computers trading against each other, just to give the algorithm volatility, right? If it was just smart money trading, what do you guys think this chart would look like?
Straight lines, one from up and one from down.
Exactly. It would look boom, 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 boom. That's what it would look like. It would literally look like that. But all of this in the middle is what gives kind of the market its character. It gives it its life, right? Because it's like, oh, it seems like it gives people the illusion of control because it looks like a real market. It's manipulated, obviously.
So are you saying that they have two computers that actually kind of trade against each other to create the look of trends?
So no, so I'm not saying that they create the look of trends. No. So what I'm saying is, have you watched the basic video of hierarchy of price?
Yes, with how they move the price from one side to the other.
No.
But you mentioned something about computers trading against each other. So I wasn't sure.
Right. So in the basics, do you remember watching the video about hierarchy of price, where I explained the pyramid of the different hierarchies of like kind of from the small fish to the big fish in the market?
Yes, but I'm not sure if I remember the conclusion.
Okay, so and what I said in that one was that in one of like the middle areas is that a lot of central banks, they're not going to manage their money themselves. They're going to make computers basically trade against each other. So they're going to basically make these computers kind of give the market volatility, give the market this feel. And that's exactly what ends up happening. So the majority of the times when you get stopped out, oh, it was the banks. No, it wasn't. It was probably just one of their computers messing with you. Now that doesn't mean that they see you sell and they're going to buy against you. No, obviously not. What's going to happen is they basically trade against each other. It's kind of difficult to explain in a beginner level. But essentially what we can assume is that since there's a lot of automated trading in the stock market and in the futures market, notice how this market is the most fluid, meaning like it's the most kind of like less choppy, more smooth type of market, right? That differs from the stock market. The futures market is the most fluid. That's because there's a lot of money being moved from one asset to another, right? That also means that the majority of the time here, there's going to be somebody moving or pushing money, right? They're going to be pushing it back and forth, back and forth, back and forth. And since humans usually aren't going to be, we don't have the brain capacity to do that. We make machines do it. We make machines push money back and forth, play ping pong with each other, right? That's all they do. So that's what gives the market the liquidity the feel of volume. And that is exactly why a lot of indicators don't work in this market, because of all that noise, essentially, right? So they're there to distract you. They're there to create noise. We can see a stark difference in the stock market, how the stock market makes a lot of sharp movements, and there's a lot of gaps in it, right? And that's because of closing hours. Obviously, if there wasn't any closing hours, it would be a lot less choppy. But there's that. And then there's also the fact that in many of those markets, it's more so manually traded, because a lot of people think like it's very difficult. Obviously, it's run by a very similar algorithm. So if you take the same theories that you've learned here and you put them into stock trading, you will be successful. So what ends up happening there is a very similar, simple thing, that the algorithm will move, but in those fields, there will not be as much noise, at least not as much as the foreign exchange market, because it has a different stigma to it. So each market will be slightly different from each other, but they will have the same base. Okay. So I hope that didn't confuse you too much. So does anybody need a screenshot of this? Does everybody have a screenshot of this? Drop a 1 in the chat if you have a screenshot of this.
One last question.
Yes,
Are there more, how to say, the banks, are they trading against each other, or they are in agreement?
Sorry, what?
Are the big banks, the smart money, they work at unison, or they trade against each other? I'm not sure if you know
So
the answer.
if they'll trade against each other, or they'll all go in the same direction?
Yes.
So, okay. If they all went in the same direction, do you think it benefits them to conflict and like fight against each other?
No, exactly. So I assume that they work together.
You assume correctly.
Okay. Yeah, that makes total sense.
There's no reason to fight against each other. You think, I'm not going to get too conspiracy theory on you guys, but do you guys really think it would make sense for people to blow each other up? It doesn't make sense. So, the people with the majority of money are probably going to know each other and they're probably going to work together. So, it just kind of makes sense. It makes sense for these banks to play together, to play nice.
Just like the whales from Bitcoin. They just play on the phone together.
Crypto whales, it's like
they
okay.
Once.
It's like, okay, guys, let's take our profit now. Hey, let me call up Jimmy. Let me call up, this other dude. Let me call up Steve and be like, hey, guys, what if we, they're like, well, I need some money. So can we drop price real quick so I can buy a little bit more? Yeah, sure, let's do it. And then, price drops.
And they buy double Bitcoin, and everybody says.
Right? Yeah. And then people keep falling for it because it makes the news. And all of these economic gurus are like, oh, wow. Bitcoin dropped, and it's like, oh, what a surprise.
And I'm happy, and I buy some more.
Yeah.
There
are no surprises in this market. Now, let me answer Utsav's question. For anybody in the recording, the class about this kind of focus ended a while ago. I apologize. I'm just answering students' questions now. So if you're watching the recording, you can go ahead and go, unless you want to listen to the answers to the questions that I have now. All right, so Utsav had a question earlier.
Sir, I have a question. Can you go to Euro USD?
Yes, I can. All right, what's up, bro?
Sir, do you see any kind of buying opportunity right now?
Buying opportunity?
Yeah.
Not a safe one.
Not a safe one. The price might drop.
Right. So I assume you're talking about okay, so price takes liquidity, now we go higher.
Yeah.
Right. Okay. So if that's what you're saying, I do agree that price is going to go higher and retrace. I would not trade into it.
You don't have any information.
You're gambling if you do that, because it could just continue dropping and then retrace later. It could retrace now.
Okay.
Right. So you don't want to do that until there's structure. If there is no structure in the market, stay out, please.
Okay. If you go to GBP AUD.
Okay. All right. Ooh, I missed this pair. I like trading this pair. All right.
No.
Okay. What was your question here?
I was thinking to buy.
To buy?
Yeah.
Price is dropping quite hard. What's your reasoning for a buy?
I was checking the oscillator. It has gone to 4%. It's majorly oversold.
You're checking oscillators?
Any concept or any structure thing. I was just going on the oscillator and I was just checking out. So that's why I was asking.
Okay. Well, what's the one thing we don't use in smart money?
Indicators.
And what are you using?
Retail trading patterns.
Right.
Yeah, retail trading patterns. Yeah.
So the oscillator probably told you that price was oversold, from here, and it's continued saying that it's oversold, and over here it's saying oversold, and people have been buying with that oscillator from here, and what do you think is going on?
Yeah. Selling is also
right. Remember, oscillators were made for the stock market. And they're still quite iffy in the stock market. There is exactly correct. Rajat said it perfectly. There is no overbought and no overbought and no oversold in the forex market. Not only in smart money trading, there is no such thing as overbought and oversold in this market. So those oscillators by default.
okay, sir. And what about those gaps which were there?
Right, the gaps. Right. So I was waiting for you to ask this question. So the gap that happened. All right. So the gap that ended up happening, let's actually end up seeing if There's
AUD
any,
USD,
oh,
it was there. It was there.
what are we running at? We're running at least 1%. All right, cool. I can't see it here, so I think I'm gonna have to go to Euro USD. All right, the gap actually made me money. Funny enough, the gap was great for me. It made me like $1,000. It was great. All right, so right here, it dropped like 150 pips, right? So it dropped 150 pips. Remember that the market is still alive while we are not trading. Remember that there is something called unofficial trading hours, basically, during the weekends, when major movers, right, and some institutions can see what's going on and kind of see how the market was affected while there was no institutional manipulation. So the algorithm stays on throughout the weekend. And it keeps calculating, but remember that there are no new orders. But there are people that get stopped out. There are certain movements in the back of the market. Remember that a lot of these currencies still have intrinsic value. And intrinsic value basically means that, you know, there's still value beneath it. Basically, there's something backing it. So if there was a major market event, like for example, the Russian ruble crashes, what would happen to the value of Euro USD and foreign currency? Actually, let me ask you, what would happen to the value of the dollar if the ruble just dropped?
It would increase.
The dollar would rise, right? The dollar would rise quite a bit. And if the dollar would rise, what would happen to Euro USD?
Obviously, it will drop.
It'll drop, exactly. So now let's look at this. This is what happened over the weekend.
Okay.
So over the weekend, boom, the Russian ruble just died, right? The Russian ruble is, I mean, the Russian economy just, you know, is in shambles right now. Because what is it? So $1 is 117 rubles. $1, 117 rubles. $1. Let's look at USD/JPY. $1 is 114 yen.
Yeah.
114 yen. If this is 114 yen, guys, and this is 117, geez, oh my God. Like it went from 80, it went from 83 rubles being $1 to 117. This thing almost doubled. Well, not almost, but you know, it got hit pretty hard, right? And since it got hit pretty hard, I mean, you know, the Russian economy is not doing too hot right now. So if that happened over the weekend, right, because there was major sanctions, and sanctions weren't all that effective, but there were certain things that they hit that were pretty important, right? And you know, Russia, a lot of their investors were feeling very skittish, so their stock market didn't quite do very well. It actually dropped quite badly. If that happens, remember, so I shared this with the GoFunded group when I did the market overview with them, and I'll share this little tidbit with you guys. Stocks, the reason that they're an indicator of an economy's wealth is not an overall indicator. So you can have a horrible economy, but you can have a good stock market. The reason why a lot of people use the stock market as a health indicator of a country is because of the fact that it indicates spending in the market. So it indicates that consumers are able to spend more on the stock market, because obviously the stock market is a luxury, right? It's a commodity. A lot of people, like for example, me, when I was growing up, I was very low class, right? I was low class. We always had what we needed, but that maybe a little bit more. That's it, right? We would have enough for our house, enough for food, and that's it. Right, and we would be, you know, doing our best to pull out any you know, extracurricular stuff that we could do, but that doesn't mean that we were investing in the stock market, right? Now, if people have more money to spend, one second, if people have more money to spend in the market, that means that generally the stock market will have more people in it. And since it'll have more money, more liquidity, more companies will do better, which means that the overall index, or the Dow Jones, the SPX, the NASDAQ 100, generally goes up. So it kind of indicates consumer confidence and consumer spending. So if Russia actually shut down their exchange on Monday, I believe, or today, I think, or last week, I don't remember, but they did not open their stock exchange. If they didn't open their stock exchange, what happened? Why wouldn't they? Because consumer confidence and consumer spending is skidding right now, right? So because of that, they want to kind of cut the bleeding. All right, what's up? You can go ahead. Sorry.
Sir, if the algorithm keeps working on the weekend, then why we don't get to see the candles on this trading view?
Because they're not official.
Working.
They're not official. So the only thing that the algorithm calculates for on the weekend is intrinsic value. The reason why gaps happen is because the value, like there was a major shift or a major move in the market over the weekend that the algorithm had to calculate for. Because remember, all of these currencies, even though they're manipulated by banks, there's still value behind them. So if, for example, the US dollar were to crash over a weekend, you'd see that reflected in the market. Now, the banks would have to reanalyze their positions, obviously, or they would have, there are some things that the banks can't predict. Like, for example, a nuke gets dropped and then the market takes a giant hit, obviously. The banks wouldn't have seen that coming, right? But, or there's a natural disaster and something happens, right? The banks don't see that coming, but they have to reanalyze and adjust, if that makes sense.
Okay. And one more thing I wanted to ask. Can we execute buy and sell limits on weekends?
No.
Okay.
Yeah. And I wouldn't suggest doing that anyway. I'd suggest closing out all of your positions no matter what. You know what's something I've never tried? I've never had a sell limit or a buy limit get hit on a gap over the weekend. I think you get triggered. I actually don't remember. That's never happened to me, so I'm not sure.
Actually, it happened with one of my friend. He was using XNS, and by mistake he has left while watching some like he was taking trades from, he was copying trades from some signal provider. He put up a he had put up a sell limit on Euro USD. Next day morning, he saw his account was it was a mini lot. His account was 1400 plus. He went for a withdrawal to XNS. He said this withdrawal won't be processed for this trade because they don't consider that trade. He says the LP doesn't approve. Like he got a mail from XNS.
Yeah, because they're like, no, that's not like, yeah. I know what you mean. Yep, that happens, unfortunately.
So, is it true or XNS is just making fool?
I mean, these brokers aren't going to want to pay you, so.
Okay.
Yeah. They're going to make any excuse they possibly can.
Yeah, maybe. Because it was just $1,000 account and again, it went to 2,400. So he asked for a withdrawal. They said, no, for this trade, we won't give.
Coach,
Yeah, some brokers will do that. Some won't, because that's technically a movement in the market. So if you held, so for a limit, generally it won't, but for a open order, I think it will.
I asked, does the limit get triggered on the weekend?
Yeah,
Like
so limits do then, yeah.
Triggered maybe when the market had opened.
Right, so they have no excuse when the order is open before the weekend now. I know that for a fact because they paid me.
Coach, I don't know if you have a minute to look over AUD USD to see how it's going or trade.
AUD USD?
Is that the one that you posted? I think so.
Yeah. What about it?
So how is going right now? And if you have a chance, if you have a minute, why do you get that trade? I can see, I look at the position, I thought, wow, this is the best position, But if you wanna analyze a little bit how it's going and
I mean, okay, so there's not much to analyze here. For this one, I kind of took a big risk, but I thought the risk would be a little bit better than the reward. Sorry, the reward would be a little bit better than the risk. At least, you know, we hit maybe 6%. There's no problem, you know, at whoops, that's not what I wanted to do. At most we hit 10. The reason why I did it, it was we had just, you know, swept a little bit of liquidity at the top, and even though, let me see something. So right here, do you guys see how at this point, so let's actually compare NZD USD to this one, and let me actually compare GBP USD to this too. So GU, I wanted GU to go higher. So in the things I've shared in the free Telegram that we have, what I've said is that I wanted price to actually go higher. I wanted price to hit up here, take out this liquidity, and then go lower. But price actually seems to, and I also mentioned in my explanation on this that I sent to my personal mentorship group, I said that we definitely can just end up dropping from here, right? That definitely is a possibility, though I would like to see price be a little bit more efficient, clear out this buy side liquidity, take this out again, I'll take out this liquidity and then continue lower. That would be a little bit more efficient in my eyes. But in this case, price just dropped. We can see that NZD USD, you know, kind of had a similar structure in sense that if we go to the 4-hour, right, price kind of wanted to tap all the way over here, right? It wanted to hit this area after taking out this liquidity, right? So I was looking at this and I was saying, okay, well, price wants to take out liquidity towards the top side anyway. So if we want to do that, then why is GU dropping like this? So in my eyes, I was like, okay, well, if GU wants to drop, right? If GU like is setting up for a drop, and now we see AU kind of already clearing its liquidity right here. It obviously has a little bit more liquidity up here. Well, probably not actually. This actually isn't liquidity. This is an area that we could have sold from. I was looking at this and I was saying, well, I could take a risk, or I could take a loss here and then take a better trade when we reach up here and get an even better risk reward trade when we drop. So I was like, okay, let me end up actually like let me take this risk. And when I saw an entry on the lower time frames, I decided to take it because I was like, you know what, this is probably going to be better than the risk. And it was like up here. I was actually going to take it like right here. I was going to take it from this, but I was like, I was being scared. I was being a scaredy cat because I was like, I should just drop my, you know, my stop loss back here. And then I was like, no, what if it goes higher? So I was basically kind of second guessing myself since this was a risky trade anyway. I was like, fine. But I think right now, like, what are we, like 1% in profit? Yeah, we're like exactly 1%. So, I mean, if you want to take your 1% right now, there'd be probably no problem in that because I didn't expect this trade to go this far. But I'm not sure what I'm going to do. I think I'm probably just going to hold it. You know, just going to hold it and risk it. You know, we're already kind of down this area. I'll see what happens when IPDA closes at around 3.
and looking at this chart, I'm not sure if you want to go over like where was liquidity. I mean, I can see it, you know, it's good to.
What do you mean? Where's liquidity?
No, I can see how they took out, you know, the liquidity. I can see the consolidation that was before and all of that we went over. Like everything you said today, I can see it in these charts as well.
Oh, this isn't a seek and destroy profile though.
No, but not, how do I say it? Not exactly, but I can see that they took liquidity from the consolidation.
Oh, right. Yeah.
They
So
went
you see
up and then they went
consolidation
down.
there, up, down, right? So now we're just kind of waiting for what side is it going for. I'd like for it to sell. If it doesn't, no hard feelings because it's 1%, and I'm like, okay, well, if not, then if it goes higher, then my second this right here, then this will make up for it. There's no problem.
So can you look into the chart of USD CAD?
Huh?
USD CAD, sir.
USD. What about USD CAD?
I say, I just want to ask if should I sell, I hold or shall I close it? Almost.
Are you
60 pips.
sure about the trade?
Yes, it's 60 pips running positive.
Oh, then yeah, close it. Why not? Take your money.
Okay.
All right. So, oh wow. So DK shared a trade with us, and this is gonna be the last thing I look over because it's very late. All right. So, wow, this class was almost 2 hours. Holy crap. Let me actually stop the recording right here for people that are watching because yeah, it's a long recording.